what's very interesting is that the bank's arrears, so they have what is called arrears. These are loans that owners of those loans are not meeting their obligations. Essentially what they're saying is they're struggling with making payments. Well, that number is very low, a lot lower than you'd expect with the 13 rate rises that we've had. But why is it low? It's underpinned by a few factors. Factor number one is that when interest rates were low and a lot of people had all this government stimulus and all this free money coming in, some of those people, what they did is they started pumping money into their loans. And they do that by either putting money direct into the loan, or if you've got what is called an offset account, which is my preferred option, because with an offset account, you can actually have the flexibility of taking money out, gives you lots of options. So what people did is they put that extra surplus money that they had into their property loan or an offset account. That means that now, as loan repayments go up, what actually happens is that buffer that they've been putting away can shelter them. The second reason why the arrears are not too bad with the banks is because employment. There is very little unemployment. So it essentially means that what you can do is actually work an extra job, work extra hours, pick up a side hustle, and you can try and make up the increased loan repayments with an extra job. The third thing that people are sort of doing, the next reason why we're not seeing arrears at the moment is that it's just too early. I mean, little do you know, like, people have really not got off those fixed rates yet. It's actually something that's now beginning to happen. And essentially, we have got, get ready for this number, 1.3 million households. 1.3 million households are going off fixed rates to variable. 850,000 of those are happening in the next 6 months. The remainder are happening next year. So, of course, if one of those properties has to be sold, and there's going to be more than one, what will actually happen is that you'll see potentially a cheap sale in a street. That then becomes the reference point, because the next set of buyers say, yeah, but that sold for that price. And that's why I'm doing everything I possibly can at the moment. Scream every vendor I can, come onto the market now. You don't want to be on the market in spring when there's 7 signboards up and one of those has actually sold at a cheap price, because the buyers will say, yeah, but that's sold at that price. This is the risk vendors are doing, sitting on the sidelines. But I don't think they're sitting on the sidelines anymore. I think they're starting to come on. And you know what's interesting? The amount of investor properties that have come on, particularly in Sydney and secondly in Melbourne. That is extraordinary. Hey, Mark, good to see you. Hey, by the way, team, I'd love you to press the share button, share this around, and make sure your clients hear it, because they're getting on the surface. They're getting at a grassroots level what's going on. So all I can say to you is, why are investors being impacted? For a few reasons. Because even though they're an investor, they've got a mortgage. And not only do they have a mortgage on their investment property, they've got a mortgage on their principal place of residence. So they're feeling it in both ways. Now, what's fascinating is that even though rents have gone up, the cost of money has far exceeded what rents have gone up. So our investors are having shortfalls, and they're also being impacted because their principal place of residence, which has a mortgage, has also gone up. So what we're seeing, and I think the statistic was that we're up at around 40% of the properties on the market were investor type stock. It's extraordinary. Now, you're gonna have to go off and just Google it and confirm that was true, because when I read that in the Fin Review, I thought to myself, that sounds a lot That sounds a lot out of 100%, that 40% of the stock are investor type stock. But many of those investors now are cashing out. But team, all I can say to you is this. With 1.3 million people, households coming off between now and, say, the next 12 months, there's going to be an impact there. There's no question about it. There's going to be an impact there. So the real issue now, I've got to say, is what do you do? What do you do if you're a buyer or seller? Well, I think if you're a seller, like if you can get this right, you sell now, and then you come back in and hopefully you can buy low. You're using the sell high, buy low strategy, right? Because there is, look, whether we like it or not, in some marketplaces, there's a bit of a mini boom going on, particularly with houses, because there's just been no stock on the market. And yes, I know that we've got immigration. I know that we've got a lot of people coming into the country, but get real. They don't get off at Mascot Airport and then take an Uber to a real estate office and say, I want to buy a property. Mate, there's a long time going to go by before they actually end up buying a piece of real estate. It doesn't happen the first month that they arrive in Australia, right? Chances are they go into an Airbnb, they live with family or friends, or then they go off and get a rental property, right? That's how it all works. Anyway, team, for those of you that are staying in Australia and not hitting overseas, let me tell you, use it to your advantage. Get on the phone, ring up your prospective vendors and say, Mr. and Mrs. Vendor, I've decided I'm not taking a holiday this winter. I'm going to stay here. It's too important. And the reason why is we realize the value of this period at the moment. Use it to your advantage. If you've got competitors that have cleared out of the country, use it to your advantage to let them know you're here. Make a ruckus, make a noise. Let people know that you're here. Let people know that you're here. And you're here because you really see the importance of transacting now before the next 1, 2, or 3 rate rises. Anyway, team, this is Tom Panos signing off.